The hidden bill: how today's economy is financing tomorrow's climate crisis. Every dollar spent in the modern economy connects to energy, transportation, agriculture, manufacturing, and technology. Those systems help create enormous wealth over the last century. They created systems of convenience and comfort that makes the world an easier place to navigate. However, like with any type of improvement, there was a price that will become one of the biggest dangers to our economic future: climate change. For years, climate change was framed mainly as an environmental issue. People pictured melting glaciers or endangered animals. Many turned a blind eye because those disasters felt far from dangerous to their lives. But economists and financial institutions are now describing climate change very differently. They no longer see it as just an environmental problem, but an economic one. They now see it as a market risk, a productivity risk, an infrastructure risk, a long-term financial liability. Money is the driving force of our world and shapes the decisions of those in power. When its future becomes endangered, it's time everyone pays attention. Climate change is no longer a fair issue only affecting coastal cities or die-hard environmentalists, but anyone who values their economic future. The modern economy rewards speed and growth. Companies chase quarterly profits. Investors want fast returns. Governments celebrate rising economic output. This system has produced incredible technological progress. It created smartphones, artificial intelligence, global shipping networks, and cheap consumer goods. But many industries grew without paying the full environmental cost of their activities. Economists call these costs externalities. Businesses profit while the long-term damage spreads across society later. Fossil fuels are one example. Oil and gas powered economic expansion for decades. They made transportation cheap and reliable. They helped build modern cities and industries. But burning fossil fuels also increased greenhouse gas emissions. Over time, those emissions warmed the planet and intensified weather events. Now governments, businesses, and taxpayers are paying billions for climate-related damage. The profits came early, the costs arrived later. The same pattern appears in modern technology. Artificial intelligence is one of the fastest-growing industries in the world. Investors are pouring billions into AI companies. But AI systems require huge data centers that consume massive amounts of electricity and water. Researchers warn that AI expansion could sharply increase energy demand if cleaner infrastructure does not grow alongside it. Smartphones tell a similar story. Every device requires mining operations, global shipping systems, factories, and constant upgrades. The convenience feels cheap. The hidden environmental costs are not. This is the central argument of the modern climate economy. Many industries generated short-term economic gains while pushing long-term environmental costs into the future. That future is arriving now. Insurance losses are increasing. Food systems are under pressure. Infrastructure damage is becoming more expensive. Governments are spending more on disaster recovery. Climate change is no longer separate from the economy. It is becoming deeply embedded inside it. The effects of climate change are no longer theoretical. They already affect daily life. Insurance premiums continue rising in regions vulnerable to floods, hurricanes, and wildfires. Some insurance companies have stopped covering homes in high-risk areas because the financial risks became too large. That changes housing markets. It changes property values. It changes where people can afford to live. Natural disasters are becoming more expensive every year. Swiss Re, one of the world's leading reinsurance and insurance companies, estimated that climate-related disasters could create more than $145 billion in insured losses during 2025 alone. Those costs do not disappear. Insurance companies raise premiums. Governments borrow money for recovery programs. Taxpayers absorb part of the burden. Consumers eventually pay through higher prices and higher taxes. Agriculture faces similar pressure. Climate change disrupts rainfall patterns, growing seasons, and soil quality. Heat waves and droughts reduce crop yields across many regions. The United Nations reports that climate change has already reduced agricultural productivity significantly in vulnerable parts of the world. That matters because food systems affect every household. When crop production fails, grocery prices rise, meat becomes more expensive, coffee prices increase, supply chains become unstable, inflation spreads through the economy. Extreme heat also affects workers. Construction crews become less productive during dangerous heat waves. Transportation systems slow down. Manufacturing facilities lose efficiency. The Intergovernmental Panel on Climate Change warns that heat stress is already lowering labor productivity worldwide. That means climate change directly affects economic output. It reduces efficiency. It lowers growth potential. It creates hidden costs throughout the economy. Many economists once treated climate change as a secondary issue. That is changing quickly. Financial institutions increasingly study climate risk because long-term instability threatens profits. Recent research suggests that climate change could reduce global economic output by 19% or $38 trillion annually over the coming decades if current trends continue. That number is difficult to imagine. It represents trillions of dollars in lost productivity, damaged infrastructure, disrupted supply chains, and weakened economic growth. This creates a major contradiction inside modern capitalism. Many industries still depend on systems that generate long-term environmental damage. Oil remains profitable. Industrial agriculture remains profitable. Consumer technology remains profitable. Artificial intelligence investment continues accelerating. Markets still reward short-term gains, even when long-term risks continue growing. That is why climate economists increasingly ask a difficult question. Are today's profits creating tomorrow's financial instability? The evidence suggests the answer may be yes. For years, climate investing sounded ideological. Many people associated environmental investing with activism rather than economics. Recently, this perception has had a swift transformation as major financial institutions now openly discuss climate exposure in economic reports and investment strategies. BlackRock, Goldman Sachs, JP Morgan, and major pension funds increasingly analyze climate risk because investors understand that instability threatens future returns. Flooded cities damage real estate markets. Droughts affect food prices and commodity markets. Wildfires destroy infrastructure and weaken local economies. Rising temperatures strain electrical grids and increase healthcare costs. Climate risk spreads throughout the financial system in ways many people never really considered or expected. Insurance companies understand this especially well. Their business depends on calculating risk accurately. As disasters become more severe and more frequent, insurance companies must pay larger claims. That forces them to raise premiums or leave certain markets entirely. Homeowners then face rising costs. Mortgage lenders face additional risk. Entire regional economies can become unstable if insurance systems weaken. At the same time, environmental protection is becoming a major investment opportunity. Clean energy infrastructure continues attracting enormous amounts of capital. Battery technology, electric transportation, advanced agriculture, and water infrastructure all represent growing industries. Investors increasingly believe the future economy will reward resilience and efficiency. Renewable energy demonstrates this shift clearly. Solar and wind power were once criticized as unrealistic or too expensive. Over the last decade, costs dropped dramatically. In many regions, renewable energy now competes directly with fossil fuels economically. Countries also want more energy independence after recent geopolitical crises exposed the risks of relying heavily on global oil and gas markets. Climate adaptation is becoming another major investment category. Governments and businesses increasingly spend money protecting infrastructure from future disasters. Flood barriers, stronger electrical grids, heat-resistant buildings, and upgraded water systems all require investment. Reuters recently reported that some climate adaptation projects could generate massive long-term savings by preventing future economic losses. This changes the climate conversation entirely. Environmental protection no longer looks only like regulation or sacrifice. It increasingly looks like financial risk management. Companies invest in cybersecurity because digital attacks threaten profits. Governments invest in national defense because instability threatens security. Climate adaptation follows similar logic. The goal is economic protection. Still, critics raise important concerns. Some climate policies increase short-term energy prices. Workers in fossil fuel industries fear job losses. Developing countries argue that wealthy nations built their economies using cheap fossil energy and now demand stricter rules from everyone else. These debates are real and complicated. Climate policy involves trade-offs, but even many critics agree on one point. Ignoring climate risk completely no longer makes financial sense. The market is beginning to recognize that environmental stability and economic stability are deeply connected. One of the biggest misconceptions about climate action is that it only creates costs. People hear about regulations, taxes, and expensive infrastructure projects. They assume environmental protection hurts economic growth. But many economists now argue that delaying action creates far larger costs later. The logic is simple. Fixing problems early usually costs less than fixing disasters later. Think about home maintenance. Repairing a small roof leak costs far less than rebuilding an entire house after years of water damage. Climate economics follows the same principle. Every year of delayed adaptation increases future damage. Infrastructure becomes more vulnerable. Insurance systems weaken. Disaster recovery costs rise. Governments borrow more money to respond to emergencies. The Organization for Economic Cooperation and Development warns that climate-related losses already threaten long-term economic prosperity worldwide. These costs compound over time. A major storm damages roads, ports, and power systems. Businesses shut down temporarily. Workers lose income. Governments spend billions rebuilding infrastructure. Insurance premiums increase again. Then another disaster strikes before recovery is complete. This creates economic instability that spreads throughout multiple sectors simultaneously. That is why many economists compare climate investment to preventative maintenance. The purpose is not ideological purity. The purpose is reducing future financial damage. Stable infrastructure protects productivity. Reliable energy systems protect businesses. Efficient water systems protect agriculture and manufacturing. Investors increasingly understand this logic. Younger investors especially often prefer companies focused on long-term resilience and sustainability, not simply because of ethics, because they believe future regulations, consumer behavior, and market conditions will reward businesses that adapt early. Capital is already shifting towards industries viewed as future-proof. Energy storage technology continues expanding. Electric transportation investment keeps growing. Advanced agricultural companies attract funding. Water infrastructure and climate-resistant construction are becoming major economic sections. History shows that economies evolve around changing incentives. The Industrial Revolution rewarded coal and oil. The Digital Revolution rewarded information technology. The next economic transition may reward resilience and efficiency. Countries that adapt early could gain major advantages. Businesses that reduce long-term environmental risk may become more competitive. Infrastructure designed for climate stability could protect economic growth while other regions struggle with increasing disruption. The important point is not whether climate change exists. Most serious economists already accept that reality. The real question is economic strategy. Will countries spend money adapting now, or will they pay far larger costs later? That decision could shape the global economy for decades. Climate change often becomes trapped inside political arguments. One side predicts total catastrophe. The other side dismisses the issue completely. Most economists approach the issue differently. They focus on incentives, costs, and long-term financial stability. The economy depends on stable systems. Reliable weather matters for agriculture. Functional infrastructure matters for business activity. Affordable insurance matters for housing markets. Productive workers matter for economic growth. Stable supply chains matter for global trade. When those systems weaken, economic growth becomes harder to sustain. That realization is slowly reshaping finance, politics, and investment strategy. Once climate change becomes a financial issue instead of only a cultural issue, different groups begin paying attention. Banks care because instability threatens lending markets. Insurance companies care because disasters increase payouts. Investors care because long-term instability threatens returns. Governments care because disaster recovery increases debt and weakens public finances. Profit drives decision-making across the economy. Increasingly, climate instability threatens profit. That may become the most important shift of all. The future economy could reward businesses and countries that understand resilience before everyone else does. The old economic model focused heavily on maximizing short-term value extraction. The emerging model may focus more on durability and long-term efficiency. Can cities survive stronger storms? Can power grids handle rising temperatures? Can food systems remain stable? Can economies continue growing without creating larger environmental liabilities? These questions are no longer only environmental concerns. They are investment questions. They are infrastructure questions. They are national security questions. They are business questions. And perhaps the biggest irony is this: protecting the environment may eventually become one of the most financially conservative decisions modern economies can make. Not because it sounds morally satisfying, because the economic numbers increasingly point in that direction. The hidden bill is already arriving. The only remaining question is how expensive it becomes.